This video is a crypto yield farming tutorial. We're going to go through the basics of yield farming, as you can see right here, how it actually works and the step-by-step process that people use. We'll also look at the leading protocols and yield farming aggregators that people will use to get the best yield farming rewards on their crypto. There's lots of different stages here, so I'll leave timestamps for everything down in the description. The way that we yield farm crypto is essentially getting rewards from either a blockchain or a protocol that we use. So there's two ways really to earn yield in finance and in crypto as well. And they are lending out your assets or providing your assets as liquidity for other people that pay fees. So if you lend out your assets, that's obviously fairly simple. You're giving someone dollars and they are going to borrow those dollars and then pay you an interest on those dollars. When you LP or provide liquidity, this is where you use two assets, for example, two stablecoins, you put them onto a decentralized exchange as liquidity. When people trade them, they pay a trading fee and that trading fee comes back to you. The yield farming part is protocols and blockchains will pay you tokens as an incentive to use them versus someone else. And so this is the middle part right here, where you have a protocol like Aave, which is for lending, or a protocol like Curve or PancakeSwap or many others, which is an exchange. And you can take the incentives that they pay you and yield farm them, so take them all in, and then do what you want with them. So these blockchains as well, some pay yield farming incentives, some don't, right? And so we have to look around at what is happening. And then on the right-hand side, these are obviously other types of investor or trader that are taking the opposite side of what you're doing. So if you're lending money to someone, that's going to him, but it's the blockchain and the protocol in the middle that we get our yield farming incentives from. We'll look at Aave as an example. This is a lending protocol, and so you can lend out your assets here. Some blockchains may pay you an incentive to get your assets onto their blockchain versus their competitor. So this is how it would work. So you have an investor right here who has some dollars that he wants to lend out, and you can go and search for some incentives to see if you can up the interest rate that you're getting, or at least boosting it with these yield farming incentives. So you can go to a protocol like Aave. There are other protocols that exist for lending. I'll leave tutorials and video guides for wallets and all of these platforms down in the description below. But as an example here, we can come and search Aave for the best yields that we can get for lending out dollars. So we're on the Aave protocol. We're going to click here to see all of the different blockchains. So let's go over to Optimism. This is a blockchain, a layer 2 blockchain on Ethereum. And we can see the market. We can see that US dollar Tether is paying 3.15% right now. So if you lend out US dollar Tether on Aave, on the Optimism blockchain, you're getting 3.15%. No yield farming rewards here. You can't see any right here. But we can go to the Avalanche blockchain. And what we can see is for Tether, we're getting 3.08%, so a little bit less. But you can see down here, the Avalanche blockchain is paying you 0.22% as a reward to use them versus the competition. It's a bear market as of making this video. Yields are very, very small, but they change every day and obviously go up during bull markets, sorry. As you can see here as well for Bitcoin, there's a bridged version of Bitcoin on the Avalanche blockchain, and Avalanche are trying to incentivize a lot of people to bring it over to them by paying 2.46% on top of Bitcoin as an incentive for people to use that market. So, that's quite a decent incentive for BTC, which typically has fairly low rates of interest if you lend it out on the Ethereum or other blockchains. So we'll get to risks of all of this stuff later, but let's say we want to lend out some Tether on the Avalanche blockchain. We get the interest from the borrower in US dollar Tether, but we also get that small amount of AVAX as an incentive as well. So what you would do here as an investor is take the Avalanche tokens that you got and you would sell them back into the US dollar Tether, and then you would go and put them back into the lending protocol. So what this is doing essentially is taking incentives and putting them back to increase your rewards on a compounding basis. So what we can go and do is go to our exchange. If you have Binance or anything else, link to a deposit and trading bonus on Binance in the description if you want that. But you need to get some US dollar Tether out onto the Avalanche blockchain. So you would buy some Tether here or get some Tether, put your address in, your wallet address, withdraw out to the Avalanche C chain. If you need to know about wallets and everything like that, links in the description as well to those videos. AVAX C chain is the chain that we want to use so we can get some US dollar Tether out onto that chain. We now have Tether onto that chain. We can connect our wallet up here, go into the Tether market, supply this right here. So now we have those Tether that are earning interest plus a small amount of AVAX token. Then when we have enough AVAX token, we can go over to Trader Joe, which is a decentralized exchange on AVAX. We can go to trade. We can trade that AVAX token for more US dollar Tether right here. So you would obviously swap that into US dollar Tether. Once you have that Tether, you then go back to the market and supply it lending. Now that's a complicated process, but there are things called yield aggregators that do all of this for you, which I'll get onto later on in the video. Before that, we'll look at providing liquidity onto exchanges. This is another way to earn fees and get any incentive rewards as well. So as a quick step-by-step guide here, I do have dedicated videos that go through all of these steps, which again, I'll link in the description. But as an overview, what you do as an investor is you get 2 tokens. You need to put 2 tokens into an exchange because someone wants to trade one for the other, and that's the liquidity that you're giving them, right? So you have these 2 assets and you put them onto some sort of protocol. Curve Finance we'll look at here as an exchange. You're going to get those trading fees plus hopefully some incentive tokens as well that you can yield farm. So we can have a look at this. This is one of the pools right here on Curve Finance. The most popular pool is Ethereum and staked Ethereum. So Ethereum is the gas token on the Ethereum blockchain. Staked ETH is the staking token. They're very similar, right, in price, and so people are happy to hold them and get some trading fees off of those. So you pick the pool right here, which is the staked ETH pool, which we're going to click into. And actually Curve does everything for you. So what you do is you just put some ETH if you have ETH on ETH mainnet. So we'll go back to our exchange. We'll get some ETH and we'll withdraw that to our wallet address on the Ethereum mainnet right here. And then we go over to Curve, we connect our wallet, and then we get some ETH and we change it into the pool. Now Curve does all of this for you. You need both of these tokens in a set ratio. Curve does all that. So what you can do is go to deposit, put in your ETH, you can connect wallet, stake it, go through with that transaction, and what you will end up having is these 2 assets in the pool and you're getting those fees. So we're on the Ethereum blockchain right here on Curve Finance, and we want to get those Curve fees and rewards. We can actually see it on the protocol right here. It tells us how much we get. We're getting a reward from fees paid by traders who are paying us those fees. We're also getting CRV rewards, which is the token for this exchange, and they pay you some reward there for using them. You also get this token as well, which is called LDO, which is the Lido Finance token. They're paying you 2.7%. Lido make staked ETH, and so they're incentivizing this pool so that you use their staking coin versus a competitor's coin. Now what we can do is put our assets on there. We can get all of those rewards in Curve and LDO token. Now what we want to do is obviously get those rewards and put them back into the strategy to get more of what we want, which is that ETH token, right? So what we can do again is get these CRV tokens and get these LDO tokens. We can quick swap those on the Curve app. So if you had some CRV tokens, you would be looking for an asset to actually switch. So you would have some CRV in your wallet right here. You would switch that back into ETH and then go to the pools again and put it back in the pool. Again, that takes a lot of fees and it takes, a lot of steps, which is why I said yield aggregators do this all automatically, which I will get onto. Yield farming, as you can see, takes a lot of steps, a lot of time. You have to go through different things and jump through hoops and then take the assets you want, sell them back in. So that's why yield aggregators exist. They basically do all of that automatically through the use of smart contracts and code. And also what they do is yield and pool a lot of assets together from different investors. And that basically takes all of the fees that have to be paid and socializes those fees across a larger pool of assets, reducing the impact of those fees basically to zero. So this is how that works. All of the steps that we just saw, choosing the asset right here, it goes to the protocol and then it goes, on whichever blockchain that it uses. It gets all of the fees and the rewards from providing liquidity and all of the incentives. It then sells those rewards back into those tokens, then puts that token back into the strategy and so on and so on. The difference is it's taking a pool of assets from many investors and doing that strategy. And so you're reducing the cost of everything, and you're making things a lot easier basically just with one button. Now they take a fee for that. On Beefy, it's anywhere from 5 to 10% of the fees and interest that is charged, right? So that's fair enough. They have to obviously make their money as well as a protocol. Now there are other aggregators which I'll show you. This one is Beefy. Many chains are supported here, so we'll just go through this. We also have Yearn Finance, which is very popular and works a lot on Curve Finance, which we just saw, which is the exchange. And you also have Harvest Finance as well, which has a few pools. So what they do here is they show you the asset that you want to invest, they show you the strategy, and then you can choose to basically do that automatically through one of these protocols as a kind of application on top, doing the strategy underneath. I don't have any links with any of these protocols or applications, and so definitely do your own research here and understand that these are businesses that are trying to incentivize us to use them as well. And so yeah, just use these at your own risk and understand what the risks are, which I'll get onto in a second. But this is the process of using these applications. So let's say we go through that Ethereum pool that we just had. So we want to earn some extra incentives on Ethereum. What we can do here is look for staked ETH. So that's the liquidity pool that we've been looking at. We can see that Beefy does this automatically for us, which is the staked ETH pool that we just saw on Curve Finance right here. So that's the exact same pool that it's using right here that we just saw. So instead of us having to do everything, we go back, we go into staked ETH, and we can see that it's earning about 5.46% at the moment from that pool. And as you can see, the complexity of the strategy, it deposits the user's assets into that pool. It then farms all of the rewards as much as it can, puts them back into the pool. And so what you get essentially is an APY of 5.46% back in the token that you invested, which in this case is Ethereum. What are the risks of yield farming then? And is it actually worth it? Well, we'll go through that in this section. There are so many individual risks that pile on top of each other that may make the vast majority of yield farming just not worth it at all. So let's go through them. The first one is asset risk. Each and every asset that you own has its own risk in terms of market risk. So US dollar Tether is a US dollar stablecoin. Do you want to hold dollars or not? Do you trust that US dollar Tether and Tether in general is a good operator that is going to not misappropriate funds, right? So they have dollars in a bank that backs the value of Tether. Is there going to be FUD around that? Is it going to lose its peg, right? There's many risks with that. In terms of other assets, risk assets are a bit different, right? So if you own some Polygon token or staked ETH or Ethereum or other tokens, we obviously know those are risk assets, and so those are volatile and can go up and down in price. But there are other types of risk as well, because there are many types of secondary tokens. So you have staked tokens here, like staked ETH and staked Matic. So these are tokens that you can buy that give you staking rewards. That's great, but are there risks with that? Like, are there smart contract risks with those assets that could potentially mean there's some trouble there in terms of the peg? So that's definitely the risk that we have to take firstly. The second one is protocol risk. So every time we use a protocol, especially if we're stacking protocols on top of each other, you're just getting a pyramid of risks, right? So can Aave as a lending protocol get hacked? Or can something happen? Can they have a bad debt? The answer is yes, like there is a risk there. And so you have to give like a percentage of risk if you want your assets on there. The second one is, can Beefy smart contracts get hacked? Is there an issue with them? Is there a backdoor? Is the protocol safe? Does it run on a multi-sig, which, is like 3 of 5. And so if 3 of the founders, go rogue, what are they going to do with smart contracts, right? Definitely risk here. Venus is a lending protocol as well, so same risks as Aave, I guess. And then Lido do a lot of the staked tokens. So again, if you're, having staked Matic or something, so we can see here, we'll search for staked ETH. Staked ETH is a token from Lido. So you have to trust that token, and you have to trust that Lido is not going to do anything crazy or get hacked as well. So there's the risk from protocol. Then you have blockchain risk. This is much lower in my opinion, right? So Ethereum is, supposed to be, no one's going to hack the actual protocol itself. A very, very low risk for that. So I'd say that's one of the lowest risks, but for sure, If you're getting incentives in Avalanche token, what's the risk that that token goes down in value? Is there something wrong with Avalanche? Is it going to get halted or something? Solana's been halted a bunch of times. So how can you put your assets on a chain that gets halted? Right, that's crazy. And so there are risks there. And then you just have outright rug and scam risk, which, to be honest, is quite high if you're using protocols that are much smaller, right? So if you go onto some smaller chains, not picking anyone out here, but if you go onto like Fuse or something, like what are these exchanges, right? Voltage exchange, like, is that going to be around? Like, we don't know, right? Like, I think exchanges that have been around for years on Ethereum obviously have a bit more trust in them. If you're going towards smaller chains and chasing yield on these chains, how much risk are you actually taking here that you wake up and like there's just a rug, right? And so these are the risks that definitely have to be thought of before getting into any kind of yield farming itself. There is also another risk to be aware of, specifically when you're hunting for yield with yield farming in liquidity pools and decentralized exchanges. It's called impermanent loss, which is massive. And for the most part, I can simplify this to say that providing liquidity with two tokens that are not exactly the same in price is going to be a bad idea for the most part. So impermanent loss works like this. You have two assets when you provide liquidity. And if they are the same price all the time, then you shouldn't have any issue. What I mean is, if you have USDT and USDC in a pool, those should be $1 at all times, and they're not going to really change, right? At least they shouldn't. Now, if you have US dollar Tether and ETH, over time, the price of those two assets is going to move greatly. ETH should, over time, well, it doesn't matter, right? If it goes up or down, it doesn't matter. You're gonna suffer from this thing called impermanent loss. This is the way that DEXs work. As you can see from this graph, the more that the price changes from when you put it in to when you take it out, you actually lose money versus just holding the tokens. And so that should be thought of. So actually, it doesn't matter if it goes up or down in price, those two assets. If they change from each other, it's going to be a loss for you. And so that's why we should never really put two assets in a pool that aren't really exactly the same. What I mean is, when you look at the yield farming protocols, you have like assets. So you have stable coins like USDC and USDT. These are okay. USDT. Then you have an asset like ETH and staked ETH. Now, these have a very similar price, right? Because one is a staking token and one is a gas token, but they're essentially almost the same thing, and they actually don't change in price. Staked ETH earns staking rewards, but you actually just get those added to your wallet. And so the price of these should be, for the most part, 1-for-1, given normal market conditions. So they're okay to add into a liquidity pool. If you choose anything else, you're going to be getting this impermanent loss, which is going to wreck you. So make sure to see that and basically not use assets that are different to each other. Trading fees minus impermanent loss equals your profit or loss. So we can look at other yield farming protocols and have an example right here. As you can see, we've got staked ETH and LDO tokens and wrap staked ETH and US dollar plus tokens. Now look at the yields on these. 36% yield, and you're thinking, great, I've got this ETH and I can supply it and get 36% yield. Brilliant. But what it's not telling you is that there is a huge amount of impermanent loss. As you can see here, it actually does tell you a big negative is that there is high expected impermanent loss, meaning that the 36% yield that you get may actually, on a net basis, after impermanent loss, be minus. And so I personally never use any pools that don't have two assets that are basically the same price and will not have an impermanent loss. The way I would go about farming then and trying to gain extra yield on my assets is this. These are the steps. Firstly, I would look at the assets that I personally own. I would not go and buy anything else just because of a yield that I see on the internet. So I would look at, firstly, the assets that I have anyway and that I may want to earn some yield on, right? So you can actually search on Beefy, which is great. And yes, there are other protocols like Yearn Finance as well, which is very similar. You've got the assets here. You can search for them. So let's just look at staked ETH. You can see that pool right here. It's giving me 4.22%. We can go back to Beefy and go on the Ethereum blockchain and see staked ETH. This is paying us 5.64. So I would probably use Beefy rather than Yearn because it's a higher yield, given that both are trustworthy protocols. But firstly, I would never ever look for just the highest yield and say, I'm going to do that. What assets are they, right? That's absolutely, definitely not the thing to do. So firstly is only using assets that I own anyway that I may want to earn yield on. The second thing is, like we've just seen, what is the yield? So you can go through different protocols and see what the yields are, and also, just compare them. Next is the protocol on the blockchain. Is Beefy okay? Is Yearn Finance okay? Do you trust one versus the other? Also, look at the pools that you're using, right? So like I said, on Fuse, we have huge APYs here, and that's because it's a smaller blockchain and it's more risky. We have assets that really shouldn't be put together. And then do you want to use these protocols? Do you want to use voltage DEX? Like, is that something that you want to use? Do you want to go to Metis and use these DEXs? Is that risk worth it for a little bit of extra yield? That can obviously be chosen by each individual investor. And then the risks and complexity, like I said, the higher the risk, the higher the yield, because they have to incentivize you. Is impermanent loss a factor? You're going to get a really high yield in pools that have high impermanent loss, but it's probably not going to work out for you anyway. And then the reliability of the yield. What happens so often with yield farming is that you choose a good stake pool or a yield farming protocol, and a few weeks after the yield farming incentives go away and your really juicy APY turns into like nothing. And then you have to go through the rigmarole of like taking the assets out again, putting them in your wallet, right? So it's kind of has to be actively managed, which again is just a pain if you don't want to. So for Beefy, you can see there are a lot of pools right here that are incentivized. Those incentives run out, the pools change. You have to actively manage that as well. So the reliability of the yield is quite big as well, because if you're getting 5 or 10% yield, it's not going to make a big difference. And so you don't want to be chopping and changing all the time. So, going to very small pools that pay a high yield for like a month and then it goes away may not be worth the effort anyway. Specific video guides for each of the platforms and wallets and how to actually go ahead with all of that are down in the description, alongside the Binance deposit and trading bonus as well. I'm James with Money's EG. Cheers for watching, and I'll see you in the next one.